Today in this video, I just wanted to share with you where the market has been this past year in 2022 and where a lot of people feel that it's going to be heading in this coming year, 2023. Hi there, I'm Vinny, Vince Mohr, your mortgage professional up and down the Central Coast and the state of California. And I've been helping clients with their home loan needs since 1985. First, I just wanted to say thank you very much again to all of you for your business and your support. As always, I certainly appreciate it. It's been quite a crazy couple of years, from historically low interest rates to with rates down in the 2s to this past year with rates up in the 7s. The reason for the such high spike in interest rates is to help try and head off inflation. When you're trying to head off inflation, basically everything goes up. Gas prices, groceries, eating out, and particularly home loans. Rates for the first time actually more than doubled in a calendar year, which had never happened in the past. But the reason for spiking the rates up is that Jerome Powell has been raising every month he's been raising the Fed rate by 0.75%, although this last hike was only 0.5%. And it does seem to be helping. Inflation has dropped from 8% in the 8% to, I believe we're at 7.2 right now. The goal is 2, but I think we could live with 3. But I like the way that he's going about it. He's just trying to get a control on it without just completely crippling rates altogether. I know that when Volcker was the head of the Fed back on the heels of the Carter administration, he just went ahead and raised the Fed rate to 20%, and that definitely took care of inflation, but took care of a lot of other things as well. So yeah, I'm glad that Jerome Powell's not doing that. I know that when I got into business back in 85, interest rates, 30-year fixed was about 12.5%, 13%, and that had fallen from a few years prior to where rates were up around 18%. It's a little bit of mixed signaling though, because although he's raising, things have increased, and he continues and will continue to raise, the Fed rate. We're still the White House, the administration is still just giving money away, so it's kind of counterintuitive. But that's way above my pay scale. But to me, it just doesn't seem like it makes a whole lot of sense. I think that they would want to curb, doling out free money at this point until we get a grip on things. Most experts and prognosticators feel that since we are they're starting to get a somewhat of a grip on inflation, that 30-year fixed will probably be somewhere between 4.5% and 5% this next year, which actually will be good news, dropping from in the 7s, down to 4.5% to 5.5%. It would be certainly welcomed, and I think that it will it'll definitely help start to spark on the economy again. I'm asked a lot as far as if I think we're in a bubble, and the short answer is no. I do think we have seen home prices start to settle the last few months, but it's basically just supply and demand, and there's still a shortage of homes that are for sale out there. It's nothing like it was back in 2008, 2009, where people were just giving their homes back to the bank, creating a glut of inventory, by foreclosures. Now people have a lot of equity in their homes, more so than ever before. Most people have at least 50% equity in their homes, and so even if they are struggling and they need to get out from underneath their house payment, they're going to more than likely do a fire sale, than they will a foreclosure. There are some foreclosures that are going on, but really, if homes are priced right, they're still going pretty quickly, a matter of weeks and in some cases days. And then if they're not, they're sitting, which hasn't happened, in quite some time. One thing that baffles me is with everybody having as much equity that they do in their homes, there's more consumer debt than there's ever been before. Over $1 trillion in consumer debt, not including the $1 trillion in student loan debt. So my reasoning or thinking would be that paying off I don't know, 10, 11, 12% automobile loan or a 25% credit card or whatever the rate is on a consumer debt, that it would make sense to just tap into some equity, as long as you're not using it for depreciating items, taking trips and buying boats and those kinds of things like we were doing the last time back in 08 and 09. But consolidating that consumer debt, because even though with rates in the sixes, it's still much better than what people have as far as the rate goes. And there's a little bit of a tax deduction there because of the interest being on your home. At very least, I would think that people would be, and this is starting to happen. A lot more people are starting to utilize seconds and equity lines of credit to get rid of that consumer debt. Again, I'm Vince Mohr, and thank you for taking the time to watch this short video. And if I could assist you or someone you know in the future with the home loan, please keep me in mind. And I hope that you certainly have a happy and blessed New Year 2023. Take care.